Most men listening to this broadcast believe they are already prepared. You look at the headlines, you see the inflation numbers, and because you are a prudent individual, you have likely purchased some gold or silver. You hold a few coins in a safe or perhaps a small position in an exchange-traded fund. You tell yourself that simply having exposure to precious metals puts you on the safe side of history. But history shows that this is not how monetary transitions work. In every major financial shift, the people who thought they were safe were often the ones who were financially destroyed, not because they owned the wrong assets, but because they owned too little of them. As we move toward the year 2026, this distinction is becoming critical. We are not entering a normal economic slowdown. We are entering a structural transition involving debt, currencies, and trust. The reason I am specifically isolating the year 2026 is based on hard mathematical data regarding the United States sovereign debt markets. Let us look at the facts. The United States government is currently carrying over $35 trillion in national debt. However, the total number is not the immediate threat. The threat is the maturity schedule. During the crisis of 2020 and 2021, the government issued trillions of dollars in short-term debt to fund stimulus programs. That debt was not locked in for 30 years. It was issued for shorter durations, and a massive wall of that debt is set to mature and requires refinancing starting in late 2025 and peaking in 2026. This is the debt wall. In the past, the government could refinance old debt at near 0% interest rates. It was essentially free money. That era is over. When this mountain of debt matures in 2026, it will not be refinanced at 0%. It will be refinanced at 4%, 5%, or even higher. Do the math with me. When you refinance trillions of dollars from 0% to 5%, your interest expense explodes. We are already seeing interest payments on the national debt exceed $1 trillion annually, surpassing the entire defense budget. By 2026, interest payments will likely consume 30 to 40% of all federal tax revenue. The government will face a binary choice. Option 1 is to default, which would destroy the global banking system instantly. Option 2 is to print the money to pay the interest. This is called financial repression. They will force the central bank to print new currency to buy the bonds that no one else wants. This dilutes the purchasing power of every dollar you saved. This is the trap. Most people think that having 5% of their portfolio in gold is enough. But if inflation hits 15 or 20% because of this money printing, a 5% allocation cannot save you. It is mathematically impossible. The gap between owning metals symbolically and owning them functionally is where most people get wiped out. To understand what enough truly means, we must look at the blueprint history has left us. To navigate the year 2026, we do not need a crystal ball. We simply need a history book. There are two specific periods in American economic history that provide the blueprint for what is coming: the 1970s and the 1940s. Most analysts make the mistake of looking at only one of these periods, but the crisis of 2026 will be a combination of both. Let us start with the 1970s. This is the era most people reference when they talk about inflation. It began in 1971 when President Nixon severed the link between the dollar and gold. The discipline was removed, and the printing press was unleashed. Between 1971 and 1980, the Consumer Price Index doubled. But the price of gold did not just double, it exploded. Gold started the decade pegged at $35 per ounce. By January 1980, it hit a peak of $850 per ounce. That is a 24 times increase in nominal terms. Think about the math of that move. If you had held 10% of your wealth in gold and 90% in cash during that decade, the purchasing power gains from that 10% in gold would have completely offset the losses from your 90% in cash. That is the definition of enough. It was not about speculation, it was about survival. However, the 1970s had one major advantage that we do not have today. The national debt was low. In 1970, the United States debt to GDP ratio was roughly 30%. Because the debt was low, the chairman of the Federal Reserve, Paul Volcker, could raise interest rates to 20% in 1980 to crush inflation. It caused a recession, but the government did not go bankrupt because the debt load was manageable. This brings us to the second part of the blueprint, the 1940s. This is the period that scares the economists the most, and it is the period that most closely resembles 2026. In the 1940s, the United States was fighting World War II. The debt exploded. Debt to GDP crossed 100%, just like it is today. The government could not afford to pay market interest rates on that debt. If rates rose too high, the war effort would have collapsed due to interest costs. So what did they do? They did not fight inflation like Paul Volcker. Instead, they used the central bank to suppress interest rates. This policy is known as yield curve control. The Federal Reserve capped long-term bond yields at 2.5%, even though inflation spiked above 10% in 1947. This is financial repression. It is a subtle form of theft. If inflation is 10% and your bond pays 2.5%, you are losing 7.5% of your purchasing power every single year. The government effectively stole value from savers and bondholders to pay down its war debt. This is the exact setup for 2026. Today, United States debt to GDP is over 120%. We look like the 1940s financially, but we have the resource constraints and supply shocks of the 1970s. We are entering a hybrid scenario. We have the high debt of the 1940s, which means the Federal Reserve cannot raise rates to 20% to fight inflation like they did in the 80s. If they did that today, the $35 trillion debt would trigger an immediate sovereign default. But we also have the inflationary pressures of the 1970s, driven by deglobalization, energy scarcity, and reckless government spending. So what happens when you combine these two eras? You get a scenario where inflation runs hot, perhaps 5, 8, or 10% annually, but interest rates are artificially held low by the central bank to keep the government solvent. This creates a deeply negative real yield environment. In this environment, cash is trash, bonds are certificates of confiscation, and equities struggle because valuations are compressed by high inflation costs. This is where the mathematical argument for gold and silver becomes undeniable. In the 1970s, gold revalued to account for the expansion of the money supply. In the 1940s, hard assets preserved wealth while paper assets were diluted. In 2026, gold and silver will likely perform both functions simultaneously. They will reprice to reflect the new quantity of money, and they will serve as the only escape valve from a sovereign debt market that is being manipulated by the state. The people who are holding a traditional portfolio of 60% stocks and 40% bonds are positioned for a world that no longer exists. They are positioned for the low inflation and low debt world of the past 40 years. They are not positioned for the high debt and high inflation reality of the 1940s and 70s hybrid. When the masses realize this, the rush into tangible assets will be violent. And as I mentioned before, the door is narrow. This is why knowing the history is not enough. You must act on the math. Now that we understand the historical trap of the debt wall, we must look at the solution. The first line of defense in your financial fortress must be gold. But before you buy another ounce, you must completely change the way you think about this yellow metal. Most men view gold as an investment. They ask, what is the return on investment? Or they compare it to the stock market. This is the wrong mindset. Gold is not an investment. Gold is money. It is the only form of money that has survived for 5,000 years. When you buy gold, you are not investing. You are swapping a failing currency for a superior currency. You are trading paper promises for physical reality. The primary role of gold in the year 2026 is not to make you rich, it is to ensure you do not become poor. It acts as a shield against the failure of traditional financial advice, specifically the death of the 60-40 portfolio. For the last 40 years, financial advisors have told you to put 60% of your money in stocks and 40% in bonds. The theory was simple. When stocks go down, bonds usually go up. They balance each other out. This worked beautifully during a period of falling inflation and falling interest rates. But in 2026, this correlation breaks down. We are entering a period where stocks and bonds can fall together. Remember the math from the previous section. If inflation is high and interest rates are rising or being manipulated, bonds lose value. If you hold a 10-year Treasury bond paying 4% but inflation is 8%, you are guaranteed to lose purchasing power. Your safe asset has become a liability. This is why the 60-40 portfolio is a trap for the coming decade. The 40% that is supposed to keep you safe is actually exposure to the very thing that is breaking, the sovereign debt market. In this environment, gold replaces bonds. Gold is the asset that has zero counterparty risk. It is the only financial asset that is not someone else's liability. If the government defaults, gold does not care. If the stock market crashes, gold does not care. It stands alone. You do not have to take my word for this. You simply need to watch what the smartest money in the world is doing. I am talking about the central banks. While they tell you that gold is a barbarous relic, while they tell you to trust the digital dollar, they are buying gold at the fastest pace in history. In 2022 and 2023, global central banks bought over 1,000 tons of gold each year. This is the highest level of buying we have seen since 1967, just before the gold window closed and the price exploded. Why are countries like China, Russia, India, Poland, and Singapore aggressively accumulating gold right now? It is not because they like jewelry, it is because they are preparing for the same debt wall that I am warning you about. They are de-dollarizing their balance sheets. They know that in 2026, the United States dollar will be weaponized to fund the debt. They know that sanctions risk is real. If you hold your reserves in dollars, the United States government can freeze your assets with the push of a button. If you hold physical gold in your own vaults, no one can freeze it, no one can hack it, no one can dilute it. China has reported adding gold to its reserves for 18 consecutive months, and those are just the official numbers. The real numbers are likely much higher. They are trading their trade surplus dollars for hard assets. They are building a gold shield. If the entities that print the money are trading their own paper for gold, what does that tell you? It tells you that they know the game is ending. They are exiting the burning theater while telling the public to stay in their seats. This brings us back to your allocation. Most individuals hold less than 1% of their net worth in gold. Pension funds hold less than 0.5%. They are completely exposed to the financial system. When the confidence in the dollar cracks, there will be a rush for the exit, but the exit door is very small. The total value of all the gold in the world is a tiny fraction of the total value of all the stocks and bonds. If just 1% of global capital tries to move into gold, the price will not just go up, it will gap up. You will not be able to buy it at the spot price you see on your screen. You will pay double or triple, or you simply won't find any metal available. In 2026, gold acts as the anchor. It provides the stability that bonds used to provide. It preserves your purchasing power against the inevitable devaluation of the currency. But while gold is the shield that protects you, it is not the weapon that attacks. For that, we need to look at a different metal, a metal that offers not just protection, but massive asymmetric upside. We need to talk about silver. While gold is the shield that protects your wealth, then silver is the sword that expands it. While gold is primarily a monetary metal held in vaults, silver is a hybrid. It is partly money, but it is largely an industrial commodity that is essential for the modern world to function. This dual nature creates what I call an asymmetric bet. The downside is limited by its monetary value, but the upside is explosive due to industrial scarcity. As we approach 2026, the supply and demand dynamics for silver are screaming a warning signal that very few people are paying attention to. We have been in a structural supply deficit for 4 consecutive years. This means the world is consuming more silver than the mines are producing. Every single year, we are eating into the above-ground stockpiles. Where is all this silver going? It is not going into jewelry or silverware. It is going into the technologies of the future. The green energy revolution is entirely dependent on silver. It is a critical component in photovoltaic solar panels. It is used in electric vehicles. It is used in the 5G infrastructure, and it is increasingly used in the electronics required for the boom in artificial intelligence. Silver is the most conductive metal on the periodic table. You cannot replace it easily. As governments around the world print money to subsidize green energy and technology infrastructure to stimulate their economies, they are inadvertently creating a massive demand shock for silver. Let us look at the numbers. The solar industry alone is now consuming a massive percentage of annual mining supply, and this number is projected to grow. But here's the problem. You cannot just flip a switch and produce more silver. Most silver is mined as a byproduct of lead, zinc, and copper. It takes 10 years to bring a new mine from discovery to production. The supply is inelastic. It cannot react quickly to price. So what happens in 2026 when monetary demand meets industrial shortage? You get a price explosion. When investors realize the currency is failing, they rush to precious metals. But the silver market is tiny compared to the gold market. It's like trying to push the water from the Hoover Dam through a garden hose. The pressure builds up, and the price goes vertical. We can see this potential by looking at the gold-to-silver ratio. This is the most important metric for silver investors. It simply measures how many ounces of silver it takes to buy 1 ounce of gold. Geologically, under the ground, there are roughly 8 parts silver for every 1 part gold. Historically, for hundreds of years, the price ratio was 15:1. Today, that ratio often sits above 80:1. This implies that silver is trading at a massive discount relative to gold. It is mathematically the cheapest asset on the planet. If that ratio were to simply revert to its historical average of 30 or 40:1, the price of silver would have to double or triple, even if the price of gold stayed flat. But in a bull market, the ratio tends to overshoot. In 1980, the ratio dropped to 17:1. In 2011, it dropped close to 30:1. History shows us that silver acts like gold on leverage. When gold moves up 10%, silver can move up 20 or 30%. It is the high-octane fuel for your portfolio. However, I must give you a serious warning. This high reward comes with high risk. Silver is volatile. It is not for the faint of heart. It will rip your face off if you are not prepared for the swings. It can drop 30% in a month during a liquidity crunch and then double in the next 3 months. This is why I call it the sword. A sword is a weapon. It is dangerous. If you do not know how to handle it, you can hurt yourself. Most men buy silver at the top of the hype cycle and sell it at the bottom in a panic. This is the wrong way to play the game. The strategy for 2026 is to position yourself before the industrial crunch becomes headline news. You want to be holding the physical metal when companies like Tesla or Apple or Samsung start scrambling to secure supply directly from the miners. We are already seeing signs of this. Strategic stockpiling has begun. While gold protects you from the government and the central bank, silver allows you to profit from the inevitable resource wars and the desperate push for technology and energy. It is the perfect hedge for a stagflationary environment where growth is slow, but inflation and resource costs are high. But owning it requires conviction. You have to be able to watch the price drop $2 and not blink. You have to understand the long-term fundamental thesis. We are running out of silver at current prices. That is a fact. The market can ignore this fact for a while, but it cannot ignore it forever. When the physical shortage becomes acute, the paper price manipulation on the futures market will break, and true price discovery will occur. This brings us to the final piece of the puzzle. How do we put this all together? How do you construct a portfolio that balances the stability of the gold shield with the explosive potential of the silver sword? And, most importantly, what is the exact number that defines enough for you and your family? We have analyzed the trap of the debt wall in 2026. We have studied the history of the 1970s and 40s. We have identified gold as the shield and silver as the sword. Now, we must answer the final and most important question. How much is enough? Let us start by destroying a common myth. Many financial advisors will tell you to hold 5% of your portfolio in precious metals. They say this is a prudent hedge. I am here to tell you that in the face of what is coming, 5% is mathematically irrelevant. Do the math. Imagine you have a portfolio of $100,000. You put $5,000 in gold and $95,000 in stocks and bonds. If we hit a stagflationary crisis like the 1970s and your stocks and bonds lose 50% of their real purchasing power, you have lost $47,500. Even if your gold doubles in price, you only gain $5,000. You are still down massively. The hedge failed because it was too small to carry the weight of the portfolio. To actually protect yourself in a sovereign debt crisis, history suggests the minimum effective allocation is 10%. This is the baseline just to tread water. This is for the man who simply wants to sleep at night and ensure he is not wiped out. However, if you want to not just survive, but thrive, if you want to be the person who can buy assets for pennies on the dollar when the dust settles, you need to be in the range of 20% to 25% of your investable net worth. This is the allocation that historically generates real wealth transfers during monetary resets. Now, how do you split that allocation between gold and silver? This depends on your age, your risk tolerance, and your goals. For the conservative investor, perhaps you are closer to retirement or you simply cannot stomach high volatility. The recommended split is 2/3 gold and 1/3 silver. This gives you the rock-solid stability of gold to preserve your life savings while giving you enough silver to capture some upside if the industrial shortage explodes. For the aggressive investor, Perhaps you are younger, or you have a strong income stream and you want to aggressively grow your capital. You might look at a 50-50 split, half gold, half silver. This is a high-octane portfolio. When it moves fast. But remember, you must have the stomach to hold through the volatility. And a word of caution, do not go 100% into anything. Do not go all in. We are not gambling. We are positioning. You still need cash for liquidity. You still need other productive assets. The goal is balance, not obsession. The year 2026 is coming whether you are ready or not. The debt will mature, the money will be printed, and the transfer of wealth will happen. The only variable is which side of the transfer you will be on. Will you be the victim of inflation, or will you be the beneficiary of sound money? The window to make these moves is closing. As more people wake up to the reality of the debt wall, the physical supply of gold and silver will vanish, the premiums will skyrocket, and the paper price will become meaningless. You want to be positioned before the panic, not during it. The fact that you have listened to this entire series tells me you are one of the few who is taking this seriously. You are looking for the truth in a world of financial noise. But information without action is useless. Look at your portfolio today. Do the math. Ask yourself if you are truly protected or if you are just hoping for the best. Hope is not a strategy. I want to hear from you in the comments below. Based on the data we discussed, what do you think is the ideal percentage for a gold and silver allocation in 2026? Do you agree with the 20% rule, or do you think it should be higher? Let us start a debate and learn from each other. If you found value in this analysis, if you want more hard-hitting truths about the economy without the sugarcoating, please click the like button. It helps us spread this message to other men who need to wake up. And most importantly, subscribe to the channel and turn on notifications. We have much more to cover regarding the specific indicators leading up to 2026, and you do not want to miss the next update. The system is changing. The rules are changing. Make sure you are holding the assets that change with them. Until next time, stay disciplined, stay prepared.